Hello traders, welcome back to another video in this diary, and today I'll go over an important part, something you've probably wanted to know for a while, and that's how to analyze Forex charts. And we're going to use technical analysis and price action in this video, and I'll go over a combination of ways that you can analyze. So let's just look at what we'll cover. So these are price action concepts for buying and selling in the Forex markets. We start with the key points of interest on any given chart. We also look at the three states of the market, which is a ranging market, a trending market, and a market that's pulling back. And we'll identify trends, and then we'll go over a few indicators and some ways you can use indicators to help you with your trading, to guide you in your decision-making process when you're analyzing your charts. Okay, so let's begin by looking at an example chart. We'll start fresh and we'll go over all of these points. So today we have this example of the dollar Swiss on the 4-hour chart. Now, when we start to look at analysis, we take into account everything that we see in terms of price action. And price action means how the price moves in the market relative to where it was before, relative to the history, and also relative to the structure of the market. So we can start with the basics and the obvious things that we see. The obvious things that we see is that we have a price which was expensive, and we can see a price that is cheap. And of course, we want to buy at the cheapest price and we want to sell at the most expensive price, and that's how we will make our profit. So as a basic concept, we have those two reference points. At the same time, we can see that between those 2 points, the market moves in swings, it moves sideways, and sometimes it moves slowly, sometimes it moves quickly. Now we have 3 states that the market always moves in. The first state is a ranging market, or what's called consolidation. Its other name is also accumulation. And where we can see that is here and here. Market is moving sideways in a smaller way here, and also a little bit here. You can mark off this point. And these are ranges or accumulations of orders. Now, the second state is a trending market, and that's when the market begins to trend, to move in a particular direction. So we can see the market trended up here, and then it began to trend down, created a range, then it trended down again, created another range, and trended down again. The third state is the pullback. So the pullback you can see here, when the market is trending down, the market pulls back and continues on its way, pulls back and continues on its downward direction. In this case, in this trend, we had very small pullbacks just here, and then the market continued. So these are the 3 states of the market. And what we ideally would like to identify is the point at which the market continues in its intended trend direction right after a pullback has finished. And that is called trend trading. A trend is defined as 2 cycles of lower high points and lower low points, which indicate that we now have a trend. And if we jump on this trend, we can make money as the market moves in our intended direction. So what we would like to do is find the best price and then get into the market at the time when we expect the price to continue in our direction. The slow points, the slowest areas, are the ranges. So we do not want to trade the ranges because then we get stuck in the market and we do not know where price is going. What we would like to do is to analyze the point at which the market begins to continue in its intended trending direction. And that key point, which you can see in this case here, in this case it started here, and in this case here, the market continued on its way in the direction of the current trend. So those key points are where we will analyze the market and analyze the best time to get in and also the best price. So we have the combination. We want to combine the price and the time, which you can see along the bottom axis, and the price along the vertical axis. Now, what do we do next? What's the next part of our analysis? Part of analysis can include indicators, and indicators are simply tools that we have available to us that will confirm, add confirmation, add a higher probability to the setup that we are intending to take. Now we have tools like Fibonacci retracements, and we also have tools like trend lines. We also have oscillators. So oscillators are indicators such as RSI, which we spoke about in another video. And we can use the RSI, which is the relative strength index, and we can also use Fibonacci. And another tool that we can use are levels. So if we just clear up this chart for a moment, where we identify significant levels, price points in our analysis that have been respected before, we can see that going back in history, we've had a significant reaction to these levels on the chart, and therefore we can expect that there will be some kind of action happening in that area. However, we don't know when and we don't know how it's going to look like, but we simply wait for that moment. So once we've made our analysis, we have our oscillators, perhaps an indicator, perhaps a Fibonacci, perhaps a level, and perhaps other trend lines, we can create a setup, a picture that looks like a high probability setup, and we wait for that expected chart, expected price action to complete. And when that does, then we will be ready to enter a trade and then ride the wave, ride the trend direction where it's intended or going, or where we predict that it will go. So that is a brief analysis of brief summary of how to analyze price action, how to analyze the chart. And what we can do is use the combinations, the rules, the set criteria that we have for any given market to identify high probability setups and look at the charts. And when we do not see a clear setup, the chart may not, the market may not at that point trend as it does clearly here. And if the market does indeed continue to move sideways later on, we do not know if that's going to happen or not, but if it does, then obviously we do not want to take part in that, because then we will be stuck in a range, we will be stuck in this movement, and nothing much will happen and no profit will be made. And there is also the risk that the market will break out and create a new trend, and therefore we will be at a loss. So we want to wait for the opportune moment at the right time and at the right price. A good way to increase the probability of your analysis is to look at the higher time frames for the direction that the market is trending in. by combining the higher time frame with the lower time frame that you're trading. For example, the 4 hours now, we can go to the daily and we can identify that the market is indeed trending down. So we want to combine that with the lower time frame, in this case 4 hour, and make sure that we are trending in that higher time frame directional bias, as we have the macro picture confirming that. And that is a brief introduction to analyzing a chart. Thanks very much for watching, and just a tip before we go, do spend more time analyzing and preparing on your charts than you do trading. The biggest mistake most traders make is they're too trigger happy. So do spend more time looking at charts and preparing for your trades, identifying your setups cleanly before you place that trade. Thanks again, and look forward to seeing you at the next diary entry, where we'll be going over another aspect of the Forex trading markets.